Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
Welcome back, everybody. Today we're doing a deep dive into the world of property investment accounting. Thinking about building wealth through property. That's awesome. But before you go picking out furniture for that vacation rental, we got to talk numbers.
Absolutely, yeah. You need a solid grasp of the financial side to really make it in property investment.
Exactly. So in this deep dive, we're going to decode property investment accounting. From the initial purchase, all the way to taxes, and even leveraging. By the end, you'll have the knowledge to make smart decisions and hopefully dodge some of those common pitfalls.
Yeah, we're drawing on the ultimate guide to property investment accounting, which you shared, along with some other research you've gathered.
Okay, so let's unpack this. What exactly is property investment accounting? I mean, why should someone even care about this stuff?
Well, it's about tracking the money, the income you're making, the expenses you're hit with, and the taxes you got to pay. And that's for your whole property portfolio. Think of it like a financial roadmap. It helps you navigate all the ins and outs of owning property and make smart choices.
So it's more than just like knowing how much rent you're collecting each month.
Oh, absolutely. Property investment accounting goes way deeper than that. It's about understanding things like depreciation, capital gains tax, and all those different methods for tracking your income and expenses.
Okay, I see why it's important. Now, the ultimate guide really emphasizes that your investment decisions should be driven by the potential of the property itself, not just chasing those tax benefits.
Right, exactly. Don't let the tax tail wag the investment dog, as they say. While tax implications matter, of course, they should come second to the property's value.
So a solid property in a prime location is better than, say, chasing tax breaks in a less desirable area. Makes sense to me.
Precisely. And you got to remember, property investment is a long game. Don't get caught up in those short-term tax benefits that might not actually align with your long-term goals.
Thinking long-term, I like it. Now, before we get into all those nitty-gritty accounting details, what about the different phases of property investment? The ultimate guide talks about pre-acquisition, project costs, and selling costs.
Yeah, you got it. Each stage has its own financial considerations. Pre-acquisition, that's all about research and due diligence, making sure the property actually fits your strategy and risk tolerance.
So like analyzing market trends, scoping out neighborhoods, and getting all those inspections done.
You got it. Then you have project costs during development or renovation, and that's where things like accurate budgeting and cost management become super important.
And then, of course, you have selling costs when you finally decide to part ways with the property. Things like real estate agent fees, marketing costs, legal fees that can add up quickly.
Oh, yeah, it can for sure. But we'll dig into those specifics a bit later. For now, let's get to the heart of real estate accounting and break down some of the key elements.
All right, let's crunch some numbers.
Okay, first up is the settlement statement. This is a super important document you get when you finalize that property purchase. Think of it like your property's financial birth certificate. It outlines all the costs tied to the acquisition, the purchase price, stamp duty, legal fees, any adjustments, all that good stuff.
This is one piece of paper you definitely don't want to lace.
Absolutely not. You'll need it for taxes and possibly for future refinancing or, of course, when you eventually sell the property.
Makes sense. What about loan agreements? Those can get pretty complicated, right?
They can. And those borrowing costs, they really add up. It's important to really understand the terms of your loan, the interest rate, repayment schedule, any fees. We'll look at how to handle these strategically so you can maximize your tax advantages.
Okay, so we've got the purchase cost covered. Let's talk about income. Whether you're renting out the property or using it for your own business, got to track that income accurately, right?
Right. And there are different methods for doing that. The two main ones are the cash method and the accrual method. Cash method's pretty simple. You recognize income when you actually receive it, and the accrual method recognizes it when it's earned, regardless of when you get the cash.
So with accrual, you might record rental income for the month even if the tenant hasn't paid you yet.
Exactly. Each method has its pros and cons. We'll dive deeper into that later. What matters is you pick a method that fits your accounting system and you stick with it.
Consistency is key. Yeah, I hear that a lot with accounting. What about those deductible expenses? The Ultimate Guide mentions things like advertising for tenants, agent fees, even bank charges.
That's right. As a property owner, you can deduct a bunch of expenses from your rental income, which can really lower your taxable income.
So those little expenses can really make a difference.
Oh, absolutely. It's all about understanding what qualifies and keeping those records organized so you can, back up your claims.
Okay, I'm seeing how important good record keeping is in all this. We'll have to dive deeper into that later.
We will. Now, let's talk about depreciation. This is where things get interesting, tax-wise.
Depreciation. I've heard the term, but I'm not really sure how it works with property investment.
Depreciation is basically a tax deduction, lets you write off a portion of the property's value over time. The idea is that assets wear out, they lose value over their lifespan.
So it's like the government saying, hey, we know owning a property comes with costs, so here's a tax break to help you out.
Exactly. And those tax savings can be significant, especially for larger properties or those with major improvements.
That makes sense. Now, I know there are different ways to actually calculate depreciation, right?
There are. The two main ones are the diminishing value method and the prime cost method. Diminishing value lets you claim a larger deduction up front, while prime cost spreads it evenly over the asset's life. We'll break it all down later, but the main point is depreciation can be a powerful tool to lower your tax bill.
All right, depreciation is definitely something I got to wrap my head around. Now, what about GST? I always thought that was just for, shoppers, not property investors.
It applies to property investment too, especially with rental income. When you're renting a place, you're basically running a business, right? So GST might apply to your rental income. But good news, you can also claim back GST on certain expenses, things like repairs and maintenance.
It's a little bit of give and take there.
Exactly. We'll cover GST in detail later on so you can be sure you're claiming everything you can. Now, ready to tackle the big one, capital gains tax or CGT.
Definitely. Everyone talks about CGT with property. Gotta admit, it sounds a little scary.
It can seem that way, but let's break it down. CGT is basically the tax on the profit you make when you sell a property.
So if I buy a place for $500,000 and sell it for $700,000, I'm paying CDT on that $200,000 profit.
That's the basic idea, yeah, but there are some details. The calculation isn't always so simple. We need to factor in things like your original purchase price, any improvements you've made, and any deductions you've claimed, like that depreciation we talked about.
Okay, so a little more complex than just subtracting the purchase price. What about that 50% CGT discount I've heard of?
Oh, that's a good one. If you've owned the property for over 12 months, you can get a 50% discount on your capital gain, so only half your profit is taxed. Big incentive to hold on to a property, right?
Wow, yeah, that IS, a big incentive. Makes you
Yeah.
think long term.
Exactly. Now, we've talked about income, expenses, depreciation, GST, and even CGT. That's a lot to keep track of.
It is, which brings us back to record keeping. It seems like it's absolutely vital for any property investor.
It really is. Think of your records as your financial armor. It's not just about following tax laws. It's about having a clear picture of your investment. Helps you make smart choices down the line.
All right, so let's dive into that record-keeping world next. What are the essentials for a property investor?
Think of those records as your financial armor. They protect you, if you get audited, and they help you see where your money's going and how your investment is actually doing.
Sounds like something I need for sure.
Oh, yeah. And remember, the ATO, they want you to keep records for at least 5 years.
5 years, okay, got it. So what should I be keeping track of specifically?
We're talking everything. Your settlement statement, loan agreements, receipts for any repairs, property management fees, even those bank charges we talked about. Having a clear audit trail, being able to trace each transaction, that's key.
Like a financial detective, huh?
In a way, yeah. That's where a good system comes in handy. Whether you're using a spreadsheet, software, even just good old file folders, pick a method that works for you and stick with it.
Got it. Got to stay organized. Now, the Ultimate Guide also talks about leveraging. Sounds like a powerful tool for property investors.
Leveraging's all about using borrowed money, usually through a mortgage, to boost your returns. Real estate's great for this because property tends to go up in value, makes it good for loans.
So instead of buying one property, I could use a mortgage to buy several and potentially see bigger returns.
Exactly. But leveraging has its risks, so don't jump in without thinking it through. We'll explore those pros and cons a little later.
Sounds like lots to consider, but also a lot of potential. What else do we need to cover in this deep dive?
We've touched on some key stuff, but there's still more. We got to go deeper into depreciation methods, those different ways to track income and expenses,
Yeah.
and the specific rules for foreign investors.
Foreign investors, that's a whole other ballgame, right?
It is, yeah. Investing in Aussie property from overseas has its own rules and tax implications. We'll break it all down so you can make smart choices whether you're investing here or from abroad.
This is super helpful. I'm starting to see the big picture. Property investment accounting, it's about so much more than just numbers. It's about making smart choices, knowing those tax rules, and setting yourself up for success in real estate.
You got it. And that's what we're here to help you with. Stay tuned. We'll be digging into all these topics in more detail in our next 2 parts. All right, let's shift gears a bit and look at how you actually analyze the financial performance of a potential property investment.
Okay, so we're going beyond just basic accounting now, getting into the strategy.
Exactly. Before you even open up your accounting software, you got to know if the property is even worth your time, you know?
Right, makes sense. Don't want to waste time on something that's not going to give you a good return.
That's it. That's where things like cash flow analysis and ROI calculations come in.
Okay, let's break those down. Cash flow analysis. That sounds pretty straightforward. Just looking at the money coming in versus money going out, right?
You got it. Cash flow analysis looks at all the income from the property, mainly rental income, and subtracts all the expenses. Things like mortgage payments, property taxes, insurance, maintenance, property management fees, if you have those.
So if the income's more than the expenses, you've got positive cash flow. And if the expenses are higher, well, that's negative cash flow territory.
Exactly. Positive cash flow means you're making money each month. Negative means you're dipping into your own pocket to cover those costs.
So positive cash flow, that's what most investors aim for, right?
It really depends on their investment strategy. Some are okay with negative cash flow for a while if they think the property value will jump up a lot over time.
So they're betting on capital growth to make up for the initial losses.
Right. But that can be risky, not for everyone. Now, let's talk ROI, return on investment. This is key for evaluating AMI investment, including property.
I hear ROI all the time, but I'm not always sure how to actually calculate it.
It's basically a measure of how much profit you make, expressed as a percentage. There are a few ways to calculate it, but a common one is dividing your net profit by the total cost of your investment.
So if I put $100,000 into a property and make $20,000 profit, my ROI is 20%.
You're on the right track, but we got to be careful about what we mean by profit. Are we talking about the annual profit or the profit after I sell? And are we taking into account the time value of money?
The time value of money, what's that?
It's the idea that money you have now is worth more than the same amount later because you could be investing it, earning interest.
So $1 today is worth more than $1 tomorrow because I could invest it and make it grow.
Exactly. So we got to be careful when we're comparing investments that have different time frames. A property with a lower annual ROI might actually be a better long-term investment if its value shoots up.
This is getting pretty complex. It's
Yeah.
more than just basic math. It's about all these different factors.
You got it. That's why it's so important to do your research, analyze those numbers, and get expert advice if you need it. Now, let's get back to the accounting side and talk about those different methods for tracking income and expenses.
Yeah, we touched on the cash and accrual methods earlier. Can you remind me what the main differences are?
Sure, cash method is all about simplicity. Record income when you get it, record expenses when you pay them. Good for smaller landlords or if you want to keep your bookkeeping simple.
Sounds pretty easy to manage.
It is, but it might not give you the most accurate picture, especially if you have a lot of outstanding invoices or bills.
So it might be harder to see how profitable you really are.
Right. Accrual method is a bit more complex, but more accurate. You record income when it's earned, even if you haven't been paid yet. And you record expenses when they happen, even if you haven't paid the bill yet.
So it's like a more forward-looking approach.
Exactly. Gives you a clearer picture of your profitability over time, helps you spot potential cash flow problems early on.
So which method's better?
No one right answer. Depends on your situation, how big your portfolio is, your comfort level with accounting stuff.
Okay, so maybe talk to an accountant to see what's best for me.
That's always a smart move, especially with complex transactions or a big portfolio. Now, let's circle back to depreciation and look at those 2 calculation methods we mentioned. Diminishing value and prime cost.
All right, ready to dive into depreciation. Remind me again why it's so important.
Depreciation's like a secret weapon for property investors. Lets you lower your taxable income by claiming a deduction for wear and tear on your property.
So instead of paying taxes on all my rental income, I can deduct some to account for the fact that my property's not brand new anymore.
Exactly. And those savings can really add up over time. Now, remember those two methods we talked about. Diminishing value, also called reducing balance, assumes your asset depreciates faster in the beginning.
Like that new car smell. It fades fast, and so does the value in those first few years.
Great analogy. Prime cost, also known as straight line, is simpler. Spreads the depreciation evenly over the asset's useful life, so you're claiming the same amount every year.
So with diminishing value, bigger tax break up front. With prime cost, it's more consistent over time.
You got it. The choice depends on a few things: what kind of asset it is, its useful life, your tax situation.
Sounds like talking to a tax pro is a good move to figure out which one's best.
Absolutely. They can help you crunch the numbers and find the best strategy for your situation. Now, let's talk about something that's often overlooked, but is so important: bookkeeping and record keeping.
I know we touched on this before, but I'm ready to go deeper. Why is it so crucial for property investors?
Good records are like the backbone of your property investment business. They're not just for taxes, they're also for making smart decisions about your investment.
So it's more than just keeping the tax man happy.
For sure. Your records give you insights into how you're doing financially, help you spot areas to improve, track your progress towards your goals, all that.
Like a financial GPS for my portfolio.
Exactly. And just like a GPS, your records gotta be accurate and up to date to guide you, right?
Okay, I'm convinced. But where do I even start? What records should I be keeping?
Everything. Income, expenses, legal documents, communications, anything and everything about your property investments.
Whoa, okay, let's break that down. What counts as income?
Rental income's the obvious one, but also track any other income the property generates, like parking fees, laundry fees, even stuff like advertising income if you have that.
All right, and what about expenses? What are the key things there?
We're talking mortgage payments, property taxes, insurance, repairs and maintenance, property management fees, basically anything you spend money on for the property.
Makes sense. And you mentioned legal documents earlier. What falls under that?
Think of things like your purchase contract, mortgage agreement, title deed, lease agreements with tenants, any building permits, insurance policies, any document that's got legal stuff about your property.
Got to be a bit of a document hoarder then, huh?
Kinda, yeah. But the key is being organized. Having a system to find those documents quickly is super important.
What about communication logs? You mentioned those. What's the purpose of those?
It's all about having that clear paper trail. You know, if there's ever a dispute with a tenant, a contractor, even the tax office, having a record of all your communication is super helpful.
So emails, letters, text messages, even notes from phone calls.
Yep. Anything that shows what was said and what decisions were made. Now you might be thinking, this is a lot of stuff to keep track of.
I got to admit, it's a little overwhelming. Any tips for staying organized?
The good news is technology can really help with this. Lots of tools to simplify things.
Like what? Give me some examples.
Accounting software is a good place to start. Plenty of options made just for property investors. They track income and expenses, make reports, even handle depreciation schedules.
So beyond just my basic spreadsheets.
Oh yeah, much more. They automate a lot of the boring stuff and keep you organized. Plus, cloud storage. Things like Dropbox or Google Drive, you can store digital copies of everything safely and access them anywhere.
So ditch the shoeboxes full of receipts and go digital.
Exactly. And if it's still too much, you can always hire a bookkeeper or accountant. They can set up a system for you, manage your records, make sure you're following all the tax rules.
That sounds worth it, especially if it saves me time and headaches later on.
It definitely can. Now let's switch gears to leveraging. It can be exciting and intimidating for investors.
Leveraging, yeah.
Yeah.
Using borrowed money to boost your returns. Definitely something I want to understand better.
It's all about using debt strategically to, increase your buying power. And real estate's perfect for this because property usually goes up in value over time.
But there are risks too, right? We talked about that.
Absolutely. Leveraging magnifies your gains and your losses, so you got to know what you're getting into.
Okay, so what are the pros and cons? What are the benefits of leveraging?
The biggest one is it lets you control a more expensive asset with less of your own money up front.
So instead of buying one place outright, I could use a mortgage to buy several and potentially see bigger returns overall.
Right. And having more exposure to the market can really speed up how fast your wealth grows.
Okay, that makes sense. But what about those risks? What can go wrong?
The biggest risk is if the property market goes down and prices drop. Because you're using borrowed money, any losses are bigger.
So if I'm leveraged a lot and the market crashes, I could end up owing more than the property's even worth.
That's a real possibility, and it can be devastating financially. You gotta have a good financial plan, choose your properties carefully, and not borrow more than you can handle.
Leveraging's a powerful tool, but you got to use it carefully. What are some things to consider before jumping into leveraging?
First, your own financial situation. Do you have a steady income, savings for emergencies, and good credit?
Got to have a solid base before even thinking about taking on more debt.
Absolutely. And also, think about how much risk you're comfortable with. Can you handle the possibility of losing money in the short term for the chance of bigger gains later?
What about the property itself? Anything specific that makes a property good or bad for leveraging?
Properties with high rental demand, good history of price increases, and low maintenance costs, those are generally good for leveraging. They make consistent income and are likely to go up in value, which makes borrowing less risky.
So basically, properties that are good investments overall.
Exactly. And don't forget about interest rates. Lower rates make borrowing cheaper, which can boost your profits. Higher rates can eat into them.
Keep an eye on those rates for sure. Now let's talk about negative gearing and positive gearing. Those are the two main approaches to leveraging, right?
Yep, two different ways to manage your cash flow and taxes.
Can you remind me what the difference is?
Negative gearing is when your rental income is less than your expenses. So you're actually making a loss, but you can use that loss to offset other income you have and lower your taxes.
So trying to lower your tax bill now, hoping to make a profit when you sell later.
Exactly. People who are focused on capital growth and are okay with losing a bit of money in the short term often do this.
And what about positive gearing?
Positive gearing means your rental income is more than your expenses, so you're actually making a profit. You can keep that profit or reinvest it.
A more conservative approach, making money from the start.
That's it. Good option if you want a predictable return or need that extra cash flow.
So which one's better?
Again, no one answer. It all depends on your situation, goals, and how much risk you're comfortable with.
Sounds like another good time to talk to a financial advisor.
Definitely. They can help you figure out the best strategy for you. Now, let's talk about a type of cost that's unique to real estate development: amenity costs.
Amenity costs, okay. What are those?
Amenities are those extras that make a property more attractive and potentially more valuable. Things like pools, gyms, playgrounds, even nice landscaping.
The stuff that makes a property stand out, attract tenants or buyers.
Exactly. But they cost money, and you got to know how to account for those costs both financially and for tax purposes.
What are some of the challenges with amenity costs?
One big one is figuring out how to allocate those costs. Do you include them in the price of each unit? Pass them on to a homeowners association? Does the developer keep ownership and run them as a separate business?
So different approaches depending on how the development's structured and who owns what.
Right. And the choice you make can have a big impact on your taxes. Like, if you build a pool that's included with each apartment, the cost of the pool is part of your development cost, and you can depreciate it.
But if you build a clubhouse that's given to a homeowners association, it's different.
Exactly. It's a complex area with lots of rules, so talking to a good accountant is key to make sure you're handling it correctly and getting the most tax benefits.
So get expert help with amenity costs. Got it. Now what about startup costs?
Startup costs are those expenses you have before your business or project starts making money. In real estate development, that could be things like market research, feasibility studies, architectural plans, legal fees, even marketing to get those first tenants or buyers.
So these are the costs of getting the project off the ground before any income comes in.
Right. And the accounting question is, do you expense those costs right away or capitalize them and spread them out over time?
Okay, what's the difference between expensing and capitalizing?
Expensing means you deduct the whole cost on your taxes this year, which can give you a nice tax break up front. Capitalizing means you spread the cost over the life of the asset or project. Smaller deductions each year, but it might show the true cost more accurately.
So expensing is a bigger tax break now. Capitalizing spreads it out over time.
That's the idea. The choice depends on what the costs are, when you expect to start making money, and what the tax rules say.
Sounds like another good reason to talk to an accountant.
Absolutely. They can guide you through it and make sure you're following the rules. Now let's talk about financing. Big part of real estate.
Financing, yeah. Getting the money to buy a property or fund a development. Essential stuff.
For sure. Understanding your financing options and what they cost is key to making good decisions. Mortgages are the most common way to finance. The lender gives you money, and you give them a claim on the property as collateral.
So the property itself is like a guarantee for the loan.
Exactly. Mortgages come in all shapes and sizes, different rates, repayment terms, fees. Shop around for the best deal and think carefully about how those terms affect your returns.
Compare loans and crunch the numbers. Got it.
Mm.
Any other financing options besides mortgages?
Seller financing is another option. The seller of the property actually gives you the loan, often with more flexible terms than banks.
So I'm borrowing from the seller instead of a bank.
Right. It can benefit both sides. The seller might get a better return, and the buyer gets easier financing.
But I imagine there are risks for both, right?
Definitely. You need a solid legal agreement that lays out all the details of the loan. Interest rate, how you'll repay it, any penalties if you're late with payments, all that.
Make sure you've got a good contract to protect yourself.
Exactly. Now, whenever you're financing a project, make sure those interest rates are fair.
How do I know if a rate is fair?
Compare rates from different lenders, look at what's happening in the market, factor in your own credit score and financial history. If you're unsure, talk to a financial advisor or a lawyer who specializes in real estate.
Don't be afraid to shop around and negotiate.
That's it. Good financing can make or break a deal, so take your time to find the best option. Now, let's zoom out and look at the bigger picture of real estate investment accounting.
Okay, we've covered a lot. What are some key takeaways for me as I keep learning about property investment?
Remember that accounting is a tool to help you make smart choices about your investments. Gives you the data you need to see if you're making money, track your progress, and adjust your strategy if you need to.
So it's not just about the numbers themselves, it's about using them to make good decisions.
Exactly. Think of your accounting system as the dashboard for your portfolio. Shows you your vital signs and helps you stay on course toward your goals.
Got to understand the numbers, A&D, how to use them. That's where knowledge and experience come in.
Right. Now let's talk about something interesting, foreign investment in Australian property.
Foreign investors, yeah, that's been a hot topic. What are the big things to consider if you're investing in Aussie property from overseas?
Australia's got a stable economy, strong property market, and a great lifestyle. That makes it popular with foreign investors. But there are specific rules. You got to know those before you jump in.
Okay, what are some of those rules?
The first one, we talked about it before, is getting approval from the Foreign Investment Review Board, the FIRB. They're like the gatekeepers. They check applications to make sure the investments are good for Australia and don't make housing too expensive for Australians.
So it's not just finding a property and making an offer.
Not for foreign investors. The FIRB application can be pretty detailed. They want to know about your finances, the specific property, your plans for the investment.
Probably a good idea to have a lawyer who knows about foreign investment help with that.
Oh yeah, they can be super helpful, making sure your application is done right and follows all the rules. Worth the cost, for sure.
Okay, FIRB approval, first step. What else?
Once you've got that, the next big thing is taxes. Australian tax law can be tricky even for Aussies, and there are specific rules for overseas investors.
Taxes, fun times. What are some of the key things for foreign investors to know about taxes?
Your tax residency status is a big one.
Right.
If you're considered an Australian resident for tax purposes, you're taxed on all your income no matter where you earned it. But if you're a foreign tax resident, you're only taxed on income you make in Australia.
So it's not just about your citizenship, it's about where you're considered a resident for tax purposes.
Right. And figuring that out can be tricky. The ATO's got a guide on their website, but getting professional advice is usually the best way to be sure you're classified correctly.
Tax residency, got to get that right. What about the property-specific taxes, like capital gains tax?
CGT, yeah. The idea is the same. It's the tax on your profit when you sell. But the rules for foreign residents can be tougher. You might have to pay a higher rate of CGT, and you might not get that 50% discount that Australians get if they've owned the property for over a year.
So foreign investors might pay more tax when they sell.
That's possible. Plus, there are rules about withholding tax on capital gains for foreign residents. So some of your money from the sale might be held back and paid directly to the ATO.
Sounds complicated. Definitely need to understand those rules and maybe get expert advice to lower my tax bill.
Absolutely. A good accountant who knows about foreign investment can be a lifesaver. They can help you structure things right and make sure you're doing everything by the book.
We keep coming back to this, but record keeping seems so important.
It really is the foundation. Good records, well organized, they're essential. Not just for taxes, but for making good decisions about your investments.
Okay, I'm getting it. Record keeping is key. But any practical tips? I don't want to drown in paperwork.
Think systems, not piles. Set up a clear way to track your income and expenses. Could be a spreadsheet, software, even a handwritten ledger if that's your thing.
Pick a method and stick with it.
Exactly. Make it a habit to update your records often, like every month. That way you've got an accurate picture of how you're doing.
And all those receipts, best way to manage those.
Go digital. Scan them, take pictures, use a receipt app. The point is to have digital copies organized by category or property. And always back up your data. Use external hard drives, cloud storage, or both. Got to protect that info.
Data security, good point. Don't want to lose everything because of a computer crash.
Right. Now let's talk about leveraging again. Using borrowed money for your property investment.
Leveraging, powerful tool, but risky too. We talked about the concept earlier, but let's get into the nitty-gritty.
One of the great things about leveraging is it lets you control a bigger, more expensive asset without needing as much of your own money up front.
Can you give me an example? I'm more of a numbers person.
Sure. Let's say you've got $100,000 to invest. You could buy one property outright, or you could use that as a deposit on a $500,000 property.
I'm borrowing the other $400,000.
Exactly. Now, if that property goes up in value, the leverage really boosts your gains. Say the value increases by 10%. Your $100,000 for that one property would become $110,000.
A 10% return, not bad.
But with leverage, your $100,000 for the $500,000 property would become $150,000.
Whoa, a 50% return. Big difference.
That's the power of leverage. Can really help you build wealth faster.
But of course, if the market goes down, those losses are bigger too.
Right. If the property value drops by 10%, your $100,000 for the single property would go down to $90,000.
A 10% loss, not great, but not the end of the world.
But with the leverage, your $100,000 for the $500,000 property would go down to $50,000.
Yikes, a 50% loss. Makes you think twice about the risks.
Definitely. Leveraging needs to be done carefully.
Okay, leverage, double-edged sword. What should I think about before using it?
Your finances are number one. Stable income, emergency fund, good credit. All essential.
So strong foundation before even thinking about debt.
Absolutely. And be honest about your risk tolerance. Can you stomach potential losses for the chance of big gains later?
What about the property? Anything that makes it better or worse for leverage?
Properties that are in high demand from renters have a history of going up in value and don't cost much to maintain. Those are good candidates. They usually make consistent income and are likely to appreciate, which helps balance out those borrowing risks.
Okay, so choosing the right property is important, along with managing my money well.
For sure. Now remember those two approaches to leveraging, negative gearing and positive gearing.
Yeah, we talked about them earlier. What's the main difference again?
Negative gearing means your rental income is less than your expenses, so you're making a loss.
Yeah.
But you can use that loss to lower your overall taxes.
Using those losses to lower your tax bill, hoping to profit when you sell.
Right. Investors who are focused on capital growth and are okay with short-term losses often use this strategy.
And positive gearing.
Positive gearing is when your rental income is more than your expenses, so you're making money. You can keep that profit or reinvest it.
So you're making money from day one with positive gearing.
Exactly. It's good if you want a more predictable return or need the extra cash flow now.
Both have pros and cons. How do I decide which one's for me?
It depends on your situation, goals, and how much risk you like.
Another time to talk to a financial advisor.
Always a good idea. Now let's talk about depreciation. It can be a bit confusing for people. Depreciation is a great way to lower your taxable income. You get to claim a deduction for the wear and tear on your property and assets.
We talked about this earlier, but I'm still a bit fuzzy on it. Why is it so important?
It's all about making the most of those tax benefits. By claiming depreciation, you're lowering your taxable income, which means you pay less tax.
So it's like the government saying, hey, we know your property is losing value over time, so here's a break.
That's a good way to think about it, and those savings can add up over the years.
Okay, I see why it's a big deal. Now, what about those different methods for calculating depreciation?
The two main ones are diminishing value and prime cost. Diminishing value, also called reducing balance, assumes the asset depreciates faster in the beginning.
So you get a bigger tax deduction up front, and it gets smaller over time.
Right, like that new car smell, it fades fast, and so does the value.
Got it. What about prime cost?
Prime cost, or straight line, is simpler. It spreads the depreciation evenly over the asset's useful life, so you deduct the same amount each year.
Consistent deduction over time.
Exactly. Which one's best for you depends on the asset, how long it's expected to last, and your tax situation.
Probably a good idea to talk to a tax professional and see what they recommend.
Absolutely. They can help you figure out the best strategy. Now, we've talked about this before, but Record keeping really is crucial.
It seems like good record keeping comes up a lot when we talk about property investment. What are the absolute must-haves for any investor, whether they're just starting or already have a big portfolio?
You're right, record keeping is so important. Think of it like building a house. You need a solid foundation. In this case, that's your income and expense records, rental receipts, bank statements, invoices for repairs, property management fees, all that good stuff.
So anything that shows money going in or out related to the property.
Exactly. Even those small things like advertising costs or bank fees, they add up, especially when it's tax time.
Got it. What about those legal documents we talked about?
Those are key too. They're like your proof of ownership and how you operate. Keep digital copies of everything. Purchase contracts, mortgage agreements, title deeds, leases, permits, insurance policies, anything that shows your legal rights and responsibilities for the property.
Organization is key then. A digital filing system sounds like the way to go.
Absolutely. A good digital system means you can find anything you need quickly, whether it's for taxes, refinancing, or if you decide to sell later on.
Makes sense. Now, you mentioned keeping a log of communications. I'll admit, I don't always think to keep records of every conversation with tenants or contractors. Why is that so important?
Think of it as your safety net. Disputes can happen, and having a record of those conversations, whether it's emails, letters, texts, or even just notes from a phone call, can really help if you need to prove something or clear up a misunderstanding.
So it's about protecting yourself and having a clear record of everything that was said and decided.
Exactly. And don't forget, technology can make this so much easier. Accounting software, cloud storage, receipt apps, use them all.
All right, I'm going digital. Now let's talk about foreign investors. Putting money into Australian property from overseas, it can be a great opportunity, but there are some extra things to think about, right?
Definitely. Australia has rules for foreign investors. It's about making sure those investments are good for the country. The first thing is getting approval from the Foreign Investment Review Board, the FIRB.
They're the ones who decide if it's okay for a foreigner to invest in property here.
That's right. They want to make sure those investments don't hurt housing affordability for Australians. So it's not as simple as just finding a property and making an offer.
So there's more to it than that.
Oh yeah, the FIRB application is pretty thorough. They want details about your finances, the property, and your plans for the investment.
Sounds like it'd be smart to have a lawyer who knows about foreign investment. Help with that.
Absolutely. They can make sure everything's filled out correctly and meets all the requirements. Worth it in the long run.
Okay, so FIRB approval is the first step.
Yeah.
What else do foreign investors need to know?
Taxes. Australian tax law can be confusing even for Australians, and there are specific rules for those investing from overseas.
Taxes, always a fun topic. What are some of the main things foreign investors need to keep in mind?
Your tax residency status is a big one. If you're considered a resident for tax purposes, you'll be taxed on all your income no matter where it came from. But if you're not a resident, you're only taxed on income you make in Australia.
So it's not just about your citizenship, it's about where you're considered a resident for taxes.
Exactly. Figuring that out can be tricky. The ATO has some guidelines, but talking to a professional is usually best to be sure you're classified correctly.
Sounds like a good way to avoid some headaches down the line. What about the taxes that are specific to property, like capital gains tax?
Capital gains tax, or CGT, applies to everyone. It's the tax on the profit you make when you sell an asset, including property. But the rules can be a bit tougher for foreign residents. You might have to pay a higher rate, and you might not get the 50% discount that Australians get if they've owned the property for over a year.
So foreign investors might pay more when they sell.
It's possible, yeah. Plus, there's something called withholding tax on capital gains for foreign residents. That means some of the money from your sale might be taken and given straight to the ATO.
So it pays to know the rules, and maybe talk to an expert to minimize your tax bill.
A good accountant who specializes in foreign investment can be really helpful. They can help you structure your investments the right way and make sure you're doing everything you're supposed to.
This has been a really informative deep dive. We've covered so much ground, from the basics of property investment accounting to special things foreign investors need to know. Any final thoughts for our listeners as they start their property investment journey?
Knowledge is key. The more you know about the financial side of property investment, the better decisions you'll make, and the fewer costly mistakes you'll make along the way.
So do your research, ask questions, and don't be afraid to get expert help when you need it.
Exactly. Property investment is a marathon, not a sprint. Build a strong foundation of knowledge, have a good strategy, and manage your money wisely.
Great advice. And don't forget the ultimate guide to property investment accounting we've been talking about. It's full of great information for anyone who wants to master property investment accounting.
It really is a valuable tool.
Well, that wraps up our deep dive for today. Thanks for joining us. Whether you're a seasoned pro or just starting out, there's always more to learn in the world of real estate.